if you're just an everyday investor, this is your first time entering the property market, and you're hearing a lot of this talk about inflation. Is there much that you should be doing or thinking about? How do I get ahead of this inflation? What are my risks to me if I'm only sitting in cash, or what investment should I be looking at?
Well, I mean, cash is a very dangerous place to be today, just because there's a huge asset price inflation going on, and you're earning no interest at all. Um, so, look, of course, there are many circumstances where having a large cash balance is appropriate, and not the least of which is if you're approaching retirement and you need to rely on retirement savings to live. You don't want to be taking too much risk with your portfolio at that stage. But I think real assets are a great hedge against inflation, and real estate in particular has demonstrated over a century of data that, be it residential or commercial, has an extremely good track record for protecting you against inflation. And I would have thought whether it's Sydney residential or you get into industrial or office leases, which are escalated by reference to CPI, they're both great options for hedging against inflation if it should rise to 4, 5, 6% as a result of the forces I mentioned earlier.
It's very interesting to think about that. It's an environment that we haven't experienced for a long time. I've only really experienced one significant crash, and then a couple growth spurts. You've been doing this longer than I have, so you can probably remember a time when interest rates were above 5 or 6%. And is this a consideration now that you're starting to think about? Do you think that we're going to be reverting to a time where we will see interest rates go above 5, 6, 7% again?
There's no imminent threat of that. I think that the abundance of money and the monetary policy settings of the federal government and to re-stimulate the economy, I'm guessing that the Reserve Bank's balance of policy will be towards stimulation, because their concern will be returning people to employment in the post-COVID era, to the extent that we're about to be vaccinated. There are many people. We've had a relatively painless passage through COVID so far, and we should be extremely grateful to good fortune, and also, I think, good government. Nonetheless, the reality is that there's still risks, and what we forget is there are many sectors like overseas students have not come back, and so all of our universities are in distress. There are industries, hotels that are dedicated largely to business travel and international tourism in distress. So there are still big sections of the economy that are not normal. And so I see there's going to be dislocation in trying to bring those people back into employment. So my balance of risk is still, the way I read the economy is I feel interest rates will probably remain sub 5% for the next 3 years. Beyond that, anything is possible. And I'm not a big fan of trying to predict things, because I think the world is inherently unpredictable. And quite often it throws in a variable completely outside, what they call an exogenous shock, comes from outside of the known variables that are being studied. And for that reason, I don't spend too much time trying to predict the future. I actually think it's quite a big waste of time.